this is the most hated bull market or the second most hated bull market ever. I think let's just go over what the happened today at the Fed. I think it was actually kind of the usual ho-hum with a little volatility sprinkled in. The Fed, of course, as expected, going into this, paused raising interest rates, but simultaneously the Chairman Powell in his press conference and even in his statement mentioned that they're very likely to raise rates further later in the year as inflation remains hot. So today, of course, as a result of that, the markets, the Dow was always under pressure because of United Healthcare. However, the rest of the Dow was kind of holding up. After the announcement, the market did the usual thing, tried to rally a tiny bit, and then it fell off, and then, of course, recovered. So today, the Dow Jones was down 230 points or so, but guess what? The S&P was up 3 points, and the NASDAQ was up, believe it or not, another 0.7%. There is no stopping the NASDAQ. And as long as this is true, and those 7 stocks that we've all heard about are holding up the market will have a buoyancy to it. The long run effect, in my opinion, of what the Fed announced today is that they own the fact that inflation is harder than they thought to come down, to get put under control, but this is always the case. And so there's nothing really new to be learned there. However, what is to be understood is that if they do raise rates later in the year, those things generally mean they spell trouble for technology. And after all, it is technology that's holding up this market. So let me start off to have a continuation of where I've been all year and where I was 2 weeks ago, and point out that generally, like many other pundits that have been struggling to understand this market, I, like many others, have held a cautious hand in 2023. In my, again, opinion, is that the market is really something that hasn't got the memo. And the memo is that there are enough things in this world that make it very difficult to own stocks. You're now starting to hear the mantra of this is the most hated bull market or the second most hated bull market ever. And it's now called a bull market because of one thing: the S&P came out of its 20% correction territory and now is only down 10% from its all-time high, pardon me, that was achieved on December 31st of 2021. And that feels almost like a miracle. Let's take a quick look at the S&P 500. And so back in October, this is when the rally started. And the rally from down here to where we are now is approximately 20%. And if we look back at the all-time highs, back here, which is, of course, December 31st of 2021, you'll see it was at 4,800. We're now at about 40, just call it 44, a little under 4,400. So we're 10% off the all-time high. And this rally has, of course, defied both expectations and gravity. The few people that were brave enough to be long have kept track with the markets. If they've been in the S&P, because guess what? The S&P 500 is still being buoyant as a result of those 7 stocks. Let's take a look at the Dow for reference. As you can see today, the Dow has really gone nowhere. The Dow also is off approximately 10% from its high. However, this year, it's really gone nowhere. It is up a marginal amount of for the year. By the way, back here just a week ago, the Dow Jones was teasing with its 200-day moving average, which, by the way, puts it essentially, if you look at where the market came into the year, would be down on the year. So just a week and a half ago, the Dow Jones was down on the year. And this is also true of the Russell. Just literally, if we look at the market, literally a week ago, here's where the market started this year. A week ago, the Russell was down on the year. And it has rallied just marginally, maybe 100 points off of that. So it's up about 3.5%. So the last 3.5%, 4% rally in these two, the markets, the Dow and the Russell, have essentially taken it from negative on the year to up that small percentage on the year. Let's look, of course, at what's really driving this. And there is the NASDAQ. Look at it go. It is now sitting actually 3 standard deviations above a long-term moving average. Traditionally, this would be a mean reversion trade. So people would be putting on a trade right now where you are short NASDAQ perhaps, and maybe long the Dow Jones. I don't like the trade, but that would be the mean revert trade. Short the NASDAQ, maybe long the Dow, long the S&P 500. But again, I don't like the trade, and here's why. Let's look at the 7 stocks. So how could these 7 stocks make all these indices go up? We'll go a little quick deeper dive. But in effect, those 7 stocks represent now almost 28% of the S&P 500. 7 stocks. There's 500, so 493. If these 7 stocks were just up only 10% on the year, the S&P would be down on the year. However, these stocks are up closer to 30% on the year. I mean, I don't need to tell you, Apple is right at almost all-time highs. Amazon, trying to recover. It's down, but it has still had a very good rally in 2023. So it's up from the mid-80s to 126. So we can say that that's a 30% rally. Google, this is even a larger. It's a 80 to 127. About the same actually as Amazon. Meta, even more, from 100 to 273. So Meta itself is up 173%. And Microsoft, of course, look at this, almost all-time highs, and it is up from 220 to 330. So that's up about 50%. Now you can see, let's look at Netflix. We know this one. This one here has been up for the year. It's still up approximately 275 to 440, another 35%. And then let's go to NVIDIA, screaming. And of course, now that is up from the beginning of the year about 300%. So these are markets that are very difficult to take advantage of because of the nature of the way they exploded higher. We are long some of them in some portfolios. However, we are not long the S&P. Now, let's take a look at that. The S&P has been out of the market this year on our behalf, mostly because, and entirely because, we have a machine learning signal that has kept us out of the market. During that period, we've had a couple of other signals on the underlying algorithm, but they were overridden by the AI because the AI is deemed more important. That being said, the AI is almost running thin. New data with the pause in interest rates may have an effect to change this, but my guess is it won't. Furthermore, if we take a look again at the main data that we look at, again, credit card defaults, car repossessions, M2 money supplies, I can tell you right now, those numbers are just expanding. Credit card debt is running at historic levels, and more people are starting to fall behind on both their car payments and their mortgages. So this is a very weird bifurcated picture. We have people falling behind on their mortgages and using credit cards to kind of hold them through these times. Yet at the same time, we have a job shortage. where apparently people can't go back to work and find jobs, and that is creating a very tight labor market that's also keeping inflation high. And those being said, that in this environment, that means corporate profits, when they're looking for new customers and new employees, corporate profits now, of course, are going to be very close to their peak levels. What can disrupt this? Obviously, further interest rate hikes, which right now the market doesn't believe will occur. I think the market personally is priced in the fact that interest rates have come down for the first 6 months of the year. I've noticed almost on these anniversary dates that the market seems to respond, literally December 31st being a high in 2021. A low was being printed again at the end of 6 months in 2022. And of course, since 2023, the market for the most part has just ground further and then gained momentum as a result again of those 7 main stocks. So we remain, and I personally remain, sadly stubborn to my view that the market is overpurchased and that a correction will occur. However, there is a time when that you must surrender the ideas. I just want the AI to do that. AI has always done better than me. And so, of course, I should probably go buy it for everybody's sake so we can put in a high, because I tend to do that very well. But that being said, I do expect some changes to occur somewhere around the turn of this month, the end of the second quarter.